Not long ago, the formula for business growth seemed obvious. More customers equals more revenue. The bigger your customer base, the more successful your business becomes. That idea shaped entire industries. Companies chased scale, expanded aggressively, and focused on reaching as many people as possible. But something unusual is happening now. Across multiple industries, companies are making more money while serving fewer customers. At first, that sounds like a contradiction. How can you earn more by selling to less? But once you understand what's changed in the business landscape, it starts to make perfect sense. Because the goal is no longer just to have more customers, it's to have better ones. The first reason behind this shift is pricing power. Instead of competing on price, many companies are moving upmarket. They're charging more for their products or services, focusing on customers who are willing to pay for quality, convenience, or exclusivity. When you raise prices strategically, you don't need as many customers to generate the same revenue. In fact, you often need fewer. And those customers tend to be more valuable, they're less price-sensitive, more loyal, and more aligned with what the business offers. So instead of chasing volume, companies are maximizing value per customer. And that changes everything. The second reason is cost efficiency. Serving more customers doesn't just increase revenue, it also increases costs. More support, more logistics, more infrastructure. If those costs grow faster than revenue, the business becomes less efficient. But when companies focus on fewer, higher-value customers, they can streamline operations. Fewer transactions, fewer support issues, more predictable demand. That leads to better margins, and in many cases, higher profits, even with a smaller customer base. Then there's the shift toward recurring revenue. Many businesses are moving away from one-time sales and toward subscription models, memberships, or long-term contracts. This means each customer generates revenue over time, not just once. So instead of constantly chasing new customers, companies focus on keeping the ones they already have. Retention becomes more important than acquisition. And when retention is strong, you don't need as many customers to grow revenue, because each customer is worth more over their lifetime. Another major factor is customer quality. Not all customers contribute equally to a business. Some are easy to serve, pay full price, and come back regularly. Others demand discounts, require more support, and leave quickly. When a company attracts too many low-value customers, it can create more work without increasing profit. So businesses are becoming more selective. They're identifying which customers actually drive value and focusing on them. This often means saying no to certain segments of the market, but in return, the business becomes more efficient and more profitable. There's also a branding advantage. When a company targets fewer, higher-value customers, it can position itself differently, more premium, more specialized, more exclusive. And that positioning allows for higher pricing, stronger loyalty, and less competition, because instead of competing with everyone, the company defines its own space. This is why many brands are intentionally limiting access, raising prices, or narrowing their audience. It's not about shrinking, it's about strengthening. Another important reason is complexity. As businesses grow their customer base, they often expand into new segments, markets, and use cases. That adds complexity. Different needs, different expectations, different challenges. And that complexity can slow down operations, increase costs, and reduce focus. By serving fewer customers, but the right ones, companies reduce that complexity. They can standardize processes, improve efficiency, and deliver a more consistent experience, which leads to better performance overall. There's also a broader shift in how success is measured. For a long time, growth was defined by size. More users, more customers, more reach. But now more companies are focusing on quality metrics, profitability, customer lifetime value, retention, efficiency. And when you focus on those metrics, the number of customers becomes less important. What matters is how much value each customer brings, and how sustainably that value can be generated. This shift is especially visible in industries where growth has slowed or competition has increased. When it becomes harder to acquire new customers, companies look inward. They optimize what they already have. They improve pricing, refine their offerings, and strengthen relationships with existing customers. And often that leads to higher profits without needing more customers. But there's a deeper strategic reason behind all of this. Serving fewer customers gives you more control. Control over quality, control over pricing, control over the overall experience. And in a more competitive and uncertain business environment, that control becomes incredibly valuable because it allows companies to build stability instead of just chasing growth. Of course, this doesn't mean that having more customers is always a bad thing. In some industries, scale is still critical, but what's changing is the assumption that more customers automatically lead to better results. That's no longer true. Because more customers can mean more complexity, more cost, and more pressure, while fewer, better customers can mean higher margins, stronger relationships, and a more focused business. So when you see companies making more money with fewer customers, it's not a coincidence. It's a strategy, a shift away from volume and toward value, and in many cases, it's proving to be a much more sustainable way to grow.